Hey everyone, it's Hunter Satterfield, one of the partners and planners here at Kane Waters and Associates, and this is your August monthly market update. For the month, the S&P 500 finished up right around 7.2%. Global stocks were up right around 6.1%, and then both domestic and global bonds were down slightly at 0.8 and 0.2% respectively. As always, I'm joined today by Brian Bortz, one of my fellow partners here at Kane Waters and the head of our investment committee, and then also Brad Sanders, who is the managing director of Tectonic Advisors. Thanks, guys, for joining me. So one of the things, in addition to the specific returns that we have seen over the past month, is really a continuing divergence for something that we've seen all year, which is really, kind of a spread between what's happening in different sectors of the stock market itself. And Brad, I know Tectonic has done a lot of research on this. Can you talk a little bit about what you guys are seeing so far this year?
Yeah, it really picked up steam in August. And really what we're seeing is when you start drilling through the market structure and drilling down and looking what's happening, really technology is kind of the only game in town. And if anybody's heard me talk recently, I've been talking about how this is very similar to 2000 in a lot of ways. If you look at, any way you want to dissect the market, if you want to look at growth versus value, all the tech stuff's in growth. Growth stocks are up 26.5% year to date, value's down 9%. So you've got about a 35% divergence there. If you start looking at sectors, tech's up 36%. The only other sector that's up for the year is consumer staples. That makes a lot of sense because you've seen grocery stores and Target and Walmart. A lot of retail chains that have a big online presence have done fantastic while people have been quarantined. But then you start looking at everything else, and it tells a completely different story. Financials, everybody might think they'd be doing okay. They're down 17%. Energy's down almost 40%. Real estate, utilities, all that are down mid to high single digits. And it's just really, even if you look at something like dividend stocks as a group are down 18% year to date. And almost all the yields on those are way higher than the US Treasury, So really, we've just seen this divergence where, people are speculating, putting their money into tech, and then everything else is kind of falling by the wayside. And that's really what's just driving index returns right now, or it's very top heavy and concentrated in a bunch of tech names.
Yeah, that's great. And I think it also, building on that, we've also been talking here a lot about how there's starting to be a spread between, what is happening from an institutional trading standpoint and what those traders are doing versus the retail traders. And they're sort of acting a little bit differently when it comes to risk on, risk off. Brian, can you talk a little bit about what you've been looking at and things we've sort of been analyzing here internally?
Yeah, thanks, Hunter. What you are starting to see is what you just mentioned, is that the very large institutional traders are starting to become a little bit more cautious and much less speculative. And that is not the story with retail investors. I think retail investors right now are caught up in a little bit of a euphoric stage of the market keeps going up and the Fed's going to protect us, so let's put our money in. And what we're trying to tell our clients is let's continue with that institutional approach and consider what your true risk tolerance is. Our outlook long term is very, very positive, but short term, anything can happen. Between now and all the uncertainties that are going to happen, the question is going to be, how will the election impact the markets? How will future tax rates impact the market? Fed monetary policy, the Fed's decision on inflation. And really, the other thing that we've talked about and what Brad's mentioned many times in his presentations is the narrowing market. We have such a narrow market right now where there's 5 or 6 winners and 494 not winners, that we really have to be smart about the level of risk that you're willing to take right now.
Yeah, and it's interesting. I mean, we've heard a lot of comparisons, in the media and in other places. Oh, this looks a lot like 2000, or this looks like a lot like, name your similar market from the past. And I do think it's important to understand that no two markets are the same. because, you know, we are, to Brian's point, in a different monetary policy than we've ever been in, and we have different tax rates and interest rates and things like that. So while we can learn from, you know, past markets and what those look like compared to this one, and I think that is an important thing, we've got to remember to continue risk mitigation strategies, maintain asset allocation and diversification during this time for, you know, the bulk of our portfolio for the reasons that Brian kind of talks about, you know, long-term perspective, and maintaining that is ultimately what's going to make our financial plan successful. So thank you so much, guys, for joining me. We will be back in front of you with a market update for September at the end of the month.